Let's say you've got 80,000 sitting in a term deposit earning 3.2%. You know exactly what it's earning. You can see it on the statement. But Centrelink looks at that same 80,000 and says, no, we think it's earning more than that. And based on what we think it's earning, we're going to reduce your pension. Not because you did anything wrong, not because anything changed in your account, just because of a formula. A formula most people have never heard of, and almost nobody explains properly. G'day, I'm Paul, and if that scenario made you sit up a little, good. That's exactly where we need to start, because this one catches a lot of retirees completely off guard. But here's what I want you to know before we go any further. This is not complicated once someone takes the time to walk you through it properly. By the end of this video, you'll understand exactly how deeming works, why it affects your pension, what the common mistake is, and what you can actually do about it. Let's get into it. So what is deeming? In plain English, deeming is the way Centrelink measures the income from your financial assets, not your actual income, your assumed income. Centrelink looks at your savings, your shares, your managed funds, your term deposits, and it says, we're going to assume these assets are earning a set rate of return. That assumed rate is called the deeming rate, and the income it produces on paper, whether you actually received it or not, is what gets counted under the income test for your age pension. There are two deeming rates at play, a lower rate that applies to the first portion of your financial assets, and a higher rate that kicks in above that threshold. The thresholds and the rates themselves can be adjusted by the government, so the exact numbers you see today may not be what applies when you're watching this. Always check with Centrelink directly or speak to a licensed financial advisor for figures that apply to your specific situation. But the structure, two rates, two thresholds, assumed income regardless of what you actually earn, that part stays constant. That's the mechanism. Now here's where it starts to feel unfair, and I want to be honest with you, because a lot of retirees I hear from feel genuinely blindsided by this. Most people assume Centrelink looks at what you actually earned on your savings, and that feels logical, doesn't it? You check your bank statement, you see the interest that was credited, you report that number. Done. But that's not how the income test works for financial assets. Centrelink doesn't care what your bank actually paid you. It applies its own rate to your total financial assets and uses that to calculate a deemed income figure. If the deemed rate is higher than what your money is genuinely earning, your pension could be reduced based on income you never actually received. Think about that for a moment. You could have 100,000 in a savings account earning a low rate because you haven't got around to switching, or because rates have dropped, or because the product you chose simply pays less. And Centrelink could be assuming that same 100,000 is earning significantly more. That gap between what you actually earn and what Centrelink assumes you earn is what catches people. And it's why so many retirees are quietly receiving less pension than they're entitled to, without ever understanding why the number changed. Which assets are we actually talking about here? Deeming applies to financial assets. That includes things like bank accounts, term deposits, shares, managed funds, account-based pensions, and certain other investment products. It does not apply to your family home, and it does not apply to most physical assets like your car or household contents. The key word is financial. If it's money or an investment sitting in an account or a fund, there's a reasonable chance deeming is being applied to it. If you're unsure whether a specific asset is subject to deeming, that's exactly the kind of question worth taking to Centrelink or a financial advisor. Here's what I want to flag, because this is the part that genuinely surprises most people. Your pension can go down not because you withdrew money, not because you sold an asset, not because anything material changed in your financial life, but purely because a formula applied a rate to your balance and produced a number that pushed your deemed income over the threshold. The formula moved, you didn't, and your pension changed anyway. That is why so many retirees describe deeming as a hidden system. It's not hidden in the sense that Centrelink is trying to deceive you. The rules are published. But it is hidden in the sense that almost no one explains it clearly before it affects you. You don't get a letter saying, by the way, here is the assumed income we're using to calculate your payment. The number just shows up in the outcome, and unless you know to look for it, you'd have no idea it was there. Here's what we're going to cover in the rest of this video. I'm going to show you the exact formula, walk through a real number example so you can see how this plays out in practice, flag the one mistake that costs retirees the most money, and then give you a clear, simple plan you can actually act on. And I want to leave you with this before we move into the numbers. The most important thing to understand about deeming is this: the pension can change because of a formula, not because you actually earned that amount. Once you understand that, everything else clicks into place. And once it clicks, you'll be in a much stronger position to do something about it. Let me show you exactly what this looks like in practice, because once you see the numbers laid out clearly, it stops being abstract and starts being something you can actually act on. Meet Margaret. She's 72, single, owns her home, and she has $180,000 in financial assets. That includes $120,000 in a term deposit and $60,000 in an everyday savings account. Her term deposit is earning 3.1%. Her savings account is paying 1.8%. If you do the actual maths on what Margaret's money is genuinely earning, you get roughly $4,800 a year in real interest, about $185 a fortnight in real income from her savings. That's it. That's what the bank is actually crediting to her accounts. But here's what Centrelink sees. Centrelink doesn't look at those individual rates. It applies the deeming rates to her total financial assets. Let's say the lower deeming rate applies to the first portion of her assets, and the higher rate kicks in above that threshold. Based on indicative deeming rates, Centrelink might calculate her deemed income at something closer to $6,500 or more per year, depending on the rates in place at the time. That's over $250 a fortnight in assumed income. A fortnightly figure that's meaningfully higher than what Margaret is actually receiving. And because that deemed income figure feeds into the income test, it pushes her assessed income higher, which flows directly through to a lower pension payment. Margaret didn't change anything. She didn't move her money. She didn't open a new account. She didn't withdraw a cent. The formula just assumed she was earning more than she was, and her pension was reduced on that basis. That is not a technicality. That is the system working exactly as designed, and it costs Margaret real money every fortnight, money she genuinely never received. Now let's talk about the mistake, because this is the one I hear about most often, and it trips up even people who consider themselves fairly on top of their finances. The common myth is this, that deeming only matters if you're earning good returns. People say to themselves, I'm in a low-interest account, my money isn't earning much, so deeming probably isn't an issue for me. And that logic sounds reasonable. It's also completely backwards. Deeming is most likely to hurt you when your actual returns are low. When there's a big gap between what your money is genuinely earning and what Centrelink assumes it's earning, that's when the formula does the most damage. If your actual return was equal to or higher than the deeming rate, deemed income and real income would be roughly the same. It's the low earners, the people sitting in older accounts, paying minimal interest, who are most exposed. Not the people with the best rates, the people with the worst ones. So if you've been assuming that your quiet, low-return savings account is staying under the radar, I'd gently encourage you to think again. Right. Here's the plan. 3 steps. Clear and in order. Step 1. Find your actual financial asset total. Log into your accounts, write down the current balance of every financial asset you hold, bank accounts, term deposits, shares, managed funds, account-based pensions, anything financial. Add them up. That single total is the number Centrelink is applying the deeming rates to. Most people have never actually added this up in one place. You need to know it before anything else makes sense. Step 2. Work out what Centrelink is likely assuming you earn. Go to the Services Australia website and find the current deeming rates and thresholds. Apply the lower rate to the first threshold portion of your total and the higher rate to anything above that. Add those two figures together. That's your deemed income for the year. Divide by 26 to get the fortnightly figure. Then compare that number to the income-free area for a single or couple pensioner, depending on your situation. The gap between your deemed income and that free area determines how much your pension is reduced under the income test. If your deemed income is sitting well under the threshold, you may not be affected. If it's over, you've just found the exact mechanism that's trimming your payment. Step 3. Take that calculation to Centrelink or a licensed financial advisor and ask them to confirm it against what they actually have on file for you. This is important. Centrelink holds asset figures that may or may not match your current balances. If you've had account movements, a maturing term deposit, a shift in share values, and you haven't notified Centrelink, they may be working from outdated numbers. You have an obligation to update them within a set time frame when your assets change, and there can be consequences for not doing so. But the flip side is that getting your figures current and accurate could also mean Centrelink recalculates your pension based on correct information, which in some cases means a higher payment going forward. Now, just to be clear, everything I've walked you through today is general information. The deeming rates, the thresholds, the pension taper amounts, all of these can change, and your personal situation will have details that affect the outcome. Before you make any decisions or updates, please confirm the current figures directly with Centrelink or talk to a licensed financial advisor who knows your full picture. Here's the takeaway. Deeming is not there to punish you, but it will quietly reduce your pension if you let a formula run on autopilot against assets it's never actually been asked to look at properly. Margaret's situation is not unusual. It's common, and the fix starts with knowing 3 things: your real asset total, the deemed income Centrelink is calculating on that total, and whether the figures Centrelink holds are actually current. That's it. 3 numbers, 15 minutes of work, potentially real money back in your pocket. If this helped you get your head around it, I'd love for you to subscribe so you don't miss the next one, and drop a comment below. Have you ever had your pension change and not understood why? Or have you already been through the process of getting your Centrelink figures updated? Tell me what happened. I read every one, and your experience might be exactly what someone else needs to hear. See you in the next one.